Service NRS has met with officials of a global professional services firm, KPMG, to address concerns and disagreements rising from the implementation of Nigeria's new tax laws. The high-level meeting held in Abuja comes amid intense debate over the implications of the new tax framework. In the report titled Nigeria's New Tax Laws, Inherent Errors, Inconsistencies, Gaps and Omissions, the international firm expressed concerns over some aspects of the laws, including the taxation of shares, dividend treatment, non-resident obligations, and foreign exchange deductions, among others. Joining me to discuss this on the program is the President of Capital Markets Academics of Nigerians, Professor Uche Nwaleke. Thank you so much for joining us at this time.
Thank you so much, Theophilus. Happy New Year to you.
Oh, same to you, same to you. Now, let's look at it from an academic and capital market perspective now. How significant is the new tax law in reshaping Nigeria's fiscal architecture? And what problem is it fundamentally trying to solve?
Yeah, once again, thank you. It's indeed my pleasure. Well, there's no gainsaying the fact that we have a tax system in Nigeria today that is not modern. We have a tax system in Nigeria that is not as progressive as it ought to be. In other words, it's not quite fair. Taxes are usually instruments of redistributing income, in any economy. And for us in Nigeria, that hasn't been the case. So one major objective, or for me, the overarching objective of the tax reforms is actually to, use it as a means to redistribute income to achieve, macroeconomic goals. Economic goals that also include reducing, poverty. So beside the issue of, raising revenues, there is also the issue of, reducing poverty, including through, boosting productivity, including through protecting the low-income earners, shifting the burden of tax, from low-income earners to high-income earners, which is why I'm happy that the reform journey has begun. The many fears that people had about the tax reforms are being allayed, allayed gradually. At least now we now know that the money you have in your bank account is no longer going to be debited by any new tax that has been introduced. There is no new tax that requires that the money you have in your bank account should be debited. As a matter of fact, if there is any debit at all, it's emanating from the electronic money transfer levy, which is now the stamp duty, or 15 naira one-off levy on any transfer made above 10,000 naira and above, and of course it's one-off. So that is what is new, the fact that it's now going to be on the sender instead of what used to be the receiver. So there isn't anything new, in that respect.
Okay.
And of course, you also look at the fact that with respect to personal income tax, low-income earners are now, going to pay less, and in some instances completely exempt. For small businesses, the threshold too has been increased. So all of this will rub off positively on the economy. Disposable income is going to improve, and of course, you expect that for the capital market, the stock market in particular, we expect that this will also, come out well, particularly so when there is the possibility that companies, many of them are listed, especially the listed companies, are going to pay, lower taxes, going forward.
Okay.
The CIT rates for big companies has been reduced from 30% to 25% in the new tax law.
Okay, so let's look at what the report by KPMG on Nigeria's new tax law, and they titled it Inherent Errors, Inconsistencies, Gaps and Omissions. Now, they've expressed concern over some aspects, including what you just talked about, shares. They talked about taxation of shares, dividend treatment, non-resident obligation, and foreign exchange deductions, among other issues. What's your take on that?
Well, my take is to say that the observations, in my view, are welcome. Any observation or view or position that will eventually help to shape the tax reform, strengthen it, of course, should be welcome. But what is important is that whatever suggestion anybody's making, or if you like criticism, has to be, done constructively. And it is in that light that I'm also seeing the views of KPMG, of course, one of the big four, and I'm happy that they have also gone to meet with the leadership of the Nigerian Revenue Service, to further seek clarification and to also say that they're actually in support of the tax reforms, and that what they released was not meant to undermine the implementation of the tax reforms. Of course, they raised a number of issues, and I'm also very comfortable with the reaction of the Presidential Committee on tax reforms. Again, putting clarity to the issues raised by KPMG.
Okay.
One of them has to do with this issue of CGT, the capital gains tax. They talked about 30%, CGT, having the potential to discourage, investments. The response by the Presidential Committee, the chairman of the Presidential Committee on tax reforms, is to the effect that a large number of transactions in the market, today are actually exempt from capital gains tax. The bulk of people that transact there, particularly retail investors, don't do volumes that are as high as 150 million, which is the threshold that will now attract CGT. 150 million naira or 10 million naira when it comes to the gain, and that the focus actually should is on ensuring that even when these investments are done in Nigeria, foreign portfolio investors, when they come, they don't just exit. And of course, when they come and exit at the slightest shock, it destabilizes the economy. So one of the intentions is actually to ensure that portfolio investors stay, and investments are more like long term in the capital market. And that is also why you find that the law says even when you sell shares above 150 million, which is the threshold, and it is reinvested within the 12-month period, again, you don't pay capital gains tax. And he also made it clear that any gain made prior to December 2025 is not going to be affected. And even for future sales, there is what is called the cost reset basis that will ensure that in calculating the cost of sale, it is the higher of the price of the share, on 31st December 2025, and the cost that at which you purchased it. So all of this will ensure that there is actually relief. Then there is also the issue of insurance companies, foreign insurance companies, premium on the tax on premium on foreign insurance companies. I think that was also explained, that there is need to provide a level playing ground. So if local insurance companies are doing taxes on premiums they write here, that for foreign companies who also write insurance deals here in Nigeria should also pay, the same, should be made to also pay tax. So that's more like providing a level playing field. Then issues around, of course, the definition of communities, classification of communities. That in one of the laws, the communities are included. In another of the laws, communities are excluded from taxable, persons, and so on. I want to also note that even the committee noted that yes, on all the laws, that they are bound to be errors and so on. But these are things that will be rectified with time. We are talking about 4 major tax laws here. And these major tax laws have, if you take the entire sections, I counted 454 sections. Okay, the Nigerian Tax Act has 202 sections. The Nigerian Tax Administration Act has 198 sections. The Revenue, the Joint Revenue Board Act has 61 sections, and the list of them is the Nigerian Revenue Service Establishment Act, which has 43 sections. When you add all of them, you have 454 sections. So in that kind of documents, the 374 page document, you are bound to see one error or the other. But what is important is that those errors are not material. Those errors should not, if you like, rubbish the entire effort. This is an effort that has taken 2 years, to come about. So I am happy with the response, from the Presidential Committee, and I'm also happy with the fact that KPMG has recognized that there is need to, have that kind of engagement in-house, which is also why the leadership of KPMG has gone to visit the NRS.
All right. So how does the timing of the tax law implementation align with Nigeria's current inflationary and growth challenges?
Yes, I think it's one reform, whose time has come. The truth of the matter is that you can't wait. You can't say you want to wait for all, conditions to be met for the right time. There's hardly ever going to be the right time, to implement, this kind of reforms. We are talking about tax laws that are as old as, in some cases, pre-independence, currently being implemented, before January 1st. So there was need to, to modernize them. There was need to, streamline the raft of, tax laws. Streamline them. One of the principles of a good tax system is that it has to be simple. It has to be, there is certainty. People should know the tax they are paying. Right now, as I speak to you, a number of states are already, adopting the harmonized state, taxes. States like Ekiti, Ondo, Zamfara. Recently, Kogi have already adopted this harmonized, state taxes. And what it does is to ensure that in a particular state or even local government, you don't have, these multiple taxes that usually constrain, businesses. So going forward, you are not going to see people now using, wood, mounting roadblocks, to collect taxes. These are what the states are now trying to do to ensure that taxes are, streamlined. So the timing, I think, is good. We need to, as I said, promote a more conducive business environment. If you look at the 2026 budget objectives, it's very clear there. The president made it clear, and one of the objectives is to promote, a good business environment. And then if we are projecting an inflation rate of 12.9 for 2026, that cannot happen where you don't have, a conducive business environment, where you have multiple taxes, constraining businesses and also adding to input costs and helping to drive up, prices. So I think the timing is is very good.
All right. So
particularly so again, so let me add this.
Okay.
That we're also having, yes, it's also been, we now have at least a fairly, a stable macroeconomic environment. That's also why I think the timing is right.
All right, so there are concerns about implementation, which many say is often Nigeria's weakest point. What are the biggest execution risks you foresee with the new tax law?
Yeah, the first is to at least get the buy-in of stakeholders, buy-in of Nigerians. Once that is done, I think implementation will be easier because a lot of it is also going to be based on self-assessments. People voluntarily willing to pay tax. As you know, the level of studies have shown that the level of tax aversion is very high in Nigeria. tax avoidance, tax evasion. Tax avoidance is not, of course, we know it's not illegal, but people, take advantage of loopholes in the tax laws, to reduce what they're paying or not to pay tax at all. And then tax avoidance is simply the reluctance to to pay tax. So that is high in Nigeria. And one way to deal with that, of course, I know one way to do it is also to build trust, to increase the if you like, the level of a social contract between the government and the people. And that's also why I think that the conversation for me should shift from whether or not this tax reform should go ahead, to what the government needs to do with the improved revenues. Talking about implementation. So by the time people see that the more money that is coming into the coffers of the government, as a result of the reforms, are being used more judiciously, I think they will also be willing to, pay tax. Implementation will be a lot, smoother. Of course, there is no doubt that technology will aid implementation, and I'm aware that the Nigerian Revenue Service, is gearing up to that. A lot will depend on technology, particularly the issue of e-invoicing. So once you have technology in place, and once the people are in support, which is also why a lot of sensitization, should be done. The National Orientation Agency, should champion it, ensuring that people really understand that the tax reforms are in their favor. Is something that is being done for the benefit of Nigerians. I just told you about the fact that anybody today in Nigeria earning 1.2, let's say at 100,000 naira a month, that's 1.2 million in a year, is not likely to pay any tax again, according to the law. As a matter of fact, the law says anybody on minimum wage should not pay tax. So if tomorrow minimum wage is increased to 200,000 or 300,000 per month, it means that according to that law, that kind of person too is not paying any tax at all. So we didn't have it before. Before now, no matter how, if people earning as low as 300,000 get subjected to a tax rate of 7%, because that's the first band. Then up to the 24%, above 3.2 million. But right now, the first 800,000, which is taxable income, not gross income. Taxable means that it can be any 1.4. By the time your reliefs are given, you get your pension, you get your national health, health insurance, you get your national housing, fund relief. You also have assurance. By the time they remove all this and they remove the rent relief, which is the 20% of your rent, or 500,000 naira, whichever is lower. By the time they remove all that, okay, you now have your taxable income. So if your taxable income is just 800,000 naira, you're not paying any tax at all. Okay. Now, when you also look at businesses, it's the same thing. Small business are also going to be exempt. They won't be paying tax. I just told you the threshold. So when people realize that these are actually in their favor, I'm sure they will be out to support it. And then implementation that you're talking about will be a lot easier.
Can one avoid paying taxes when you have multiple bank accounts? Because that's some insinuations have gone on in the streets that once you have multiple bank accounts and transfer money from these different bank accounts, you're avoiding taxes.
Yes, you see what I was talking about, the need for this awareness. At least the implementation has begun, as I mentioned earlier. People now know that nobody's hitting their bank accounts or deducting monies kept in their bank account. It's only when you do a transfer. Now the law says when you do a transfer, okay, the same account holder, if you do a transfer to your own account in the same bank, they don't charge you stamp duty. So it's only when you transfer money to someone else that stamp duty is charged, and that stamp duty is just 15 naira, on 10,000 naira and above. It is not on every 10,000, but it's on 10,000 naira and above, and it's on the sender. So when you now check your account and you find that 15 naira has been charged you didn't send but you received, it's not on the receiver. Okay, we hear that some banks charge both the receiver and the sender, but that is not what the law says. The law says it's only on the sender. So when you now get to your account and you find that you received money you didn't send and the charge is being done to your account, that is when you complain. So when you have multiple bank accounts, as I said, it's only when you make that transfer. If you do 3 transactions or 4 transactions and they're in excess of 10,000, that's when you pay. But if you do make those transactions and they are not up to 10,000, again, the law says you are not to pay any stamp duty. So it's important we understand, the public understands, this.
So just to be clear, you transfer 10,000 naira in 3 folds. It means that you will pay 15 naira stamp duty per 10,000 naira, right?
Yes. 3 transactions.
Yes.
3 different transactions. But if you transfer 30,000, instead of doing 10,000 in 3 places, and you do it 30,000, it's just 50 naira you're paying, because it is one-off. It is based on a single transaction. Okay.
So you even if you transfer 100,000 naira or 200,000 naira, just 50 naira.
It's just that 50 naira.
Okay.
Yes.
Okay.
So as I said, bank customers should watch out for this, and also not confuse this with the other charges that banks are also doing. The normal bank charges.
Yeah.
And my advice is, a bank customer should always be familiar with the approved charges by the central bank. And when they notice any irregularity or any unauthorized debit, they should quickly alert the bank. And if the bank doesn't address that within 2 weeks, central bank says escalate that to us, and then they will handle that.
All right. So as we approach the release of December inflation figures now, what underlying drivers should markets prioritize in their analysis?
Okay, well, of course, November inflation came in at 14.45.
Yes.
We also know that the food inflation is actually now even lower than core inflation. You have food, you have the core. The core component is the one that excludes the seasonal, other seasonal elements such as agri and energy. So for the month of December, I want to expect that, of course, the results should be out next tomorrow. That's on the 15th. I want to expect that it may come in slightly higher than that of November, and that's on the back of the fact that December period is usually characterized by high demand. We understand even in the month of November, cash in circulation increased, and transport fares also increased in December, including airline fares and transport. So one should expect that core inflation may increase, but I think this will come up slightly. But we have not had any major fundamental shifts, in terms of prices. If you also check in December, we had some level of stability. Fuel price was relatively stable. It was available, unlike previous years. Food prices too were not, they didn't go haywire, unlike previous years. So that's why I feel the impact on prices might not be much. So we may not see any major upheaval. But the figure you are likely to see released by National Bureau of Statistics may be huge. Okay, some have said as huge as maybe close to 30% or even more than 30% compared to November figure. But MBS has taken a proactive measure to explain. Yesterday, they had an engagement with stakeholders in conjunction with the Nigerian Economic Summit Group, trying to explain what is likely to happen to the December figure. December figure is going to be high, not because of any, as I said, any shift in the fundamentals in the economy, okay, but more because of what is called the base effect. So it's more of an arithmetic, more of a technical thing than the actual price movement. And what is that technical thing? It's called the base effect. If you remember, the National Bureau of Statistics rebased the consumer price index. They also rebased the gross domestic product. But when they rebased the consumer price index, what they did was to move the base year. Rebasing means you change the base year. So they moved it from 2009 to 2024, and then used December 2024, they made it 100. 100 means base. CPI means Consumer Price Index, and an index shows you movement between one period and another. So you're dealing with a starting point, which is the base. So when they did that, okay, as I said, it affected the numbers that came in from January up till November, because more or less what they did was to try to let the inflation figure reflect current consumption. So in the course of doing that, they removed about 240 products from their old basket and introduced about 400. So we now have from 740 commodities that used to be in their basket, we now have 934. Okay, so with the rebasing and all that they have done, we now have new inflation, series. But the one for December is going to suffer from that base effect because it was December they used as, the base. Let me explain this thing, maybe in a way you understand this.
Yeah, okay.
If you move from 100 and the price is increasing from 100 to 110, for example, if you want to calculate percentage increase in the price, you would say it's increased by 10 or it increased by 10%. That is 10 divided by 100. 100 is the base times 100, so it increased by 10%. But that same 10, that same movement, that same increase, if you now place it on a lower base, instead of doing it on 100, you now do it on 50. 50 is lower than 100. What are you going to get? You're going to get a rate that is now higher than that of 10. So instead of having 10%, if you do 10 over 50, a new base, a lower base, you now have 20%. All right? So the base they used for December 2024, 100, is lower. And because it is lower, you're likely to see when they calculate the inflation figure for December of 2025, because it is year on year, you're likely to see a higher inflation figure brought about as a result of that calculation. That's why I said it's artificial. The increase is going to be artificial. It's not real, which is why the National Bureau of Statistics has also said that they are going to normalize it. They plan to normalize it, and then, so that going forward, we don't experience, such, artificial numbers in the inflation figures. And the good thing is that in doing this, they had the support of the World Bank, the IMF, and even the Central Bank of Nigeria. These institutions that are going to also use these numbers. So researchers, don't have anything to worry about because, as I said earlier on, the entire series, will be normalized. So inflation figure for December, when we see it, we shouldn't, bother about the number is artificial. We should just worry about what the real, NBS will also be, saying it, the real, what the inflation, should have been.
All right, thank you so much. Of course, listening to you educate us is quite refreshing. Thank you so much, President of Capital Markets Academics of Nigeria, Professor Uche Nwaleke. Thank you so much for talking to us.
Thank you, Theophilus. Thank you.
Well, still to come on